Alright, hello everyone. Today is a very exciting day. We had a lot of things that happened last night. Two big things. Number one, the Fed policy pivot, which is them cutting the rates as well as some of the things they share, as well as the big tech earnings, which is Microsoft, Google and Meta all reported yesterday. So this video is about 30 minutes long, but I have a lot of value jam-packed for you. So make sure to stay till the end because I think that you will find a lot of knowledge and value that will help you to determine your strategy, okay? And we will also see, could this actually shake up the market next year, okay? So let's get started right away. Alright, so before that, if you haven't done so, I would appreciate it if you hit the like and subscribe, and it will really help me to keep making these videos for you. Now, let's get started. Okay, again, remember that the Federal Reserve, right, they have this thing called the dual mandate. What does this dual mandate mean? It means that they have two main things in their policy. Number one is to achieve maximum employment. So that means an unemployment rate of 3.5 to 4.5%, as well as to maintain price stability, which means managing inflation to be about 2%. Now, let's look at what happened yesterday for the rate cuts. So you can see this morning, we finally got a confirmation that the Federal Reserve will cut rates by 25 basis points or 0.25%. So it's from 4 to 4.25. Now he cut 0.25 to become 3.75 to 4. But note, guys, he also said something about the rate cut in December. It is not a foregone conclusion. Okay, so let me highlight it right over here. It is not a foregone conclusion. Now, what does Powell mean by this particular thing, right? Because everything that he says, right, let me tell you, the market will nitpick every single word he says. So when he says this, suddenly everyone gets concerned. Why? Because everyone has already forecast, the market has already forecast that in December, the Federal Reserve will cut the rates. But right now, what he is saying is that it is not confirmed. Now, look at this chart. On just today, after he announced that, you can see that now the percentage, the odds of him cutting rates in December, right, has already changed. Okay, now it's how many percent? 70%. But just one day ago, guys, you can see, it is at 90.5% for him to cut, Now, right, totally, it is at 0% for him to cut, And they have 70% chance that he will maintain the rates. So you can see how the balance has shifted totally. So this is what is happening right now on what the Federal Reserve is doing. But let's dig deeper into what else the Fed said. Now, before that, I want to share with you these two concepts called quantitative easing and quantitative tightening. So basically, right, the Federal Reserve, they have two main tools to manage the economy. Number one is interest rates, which is like stepping on the accelerator. And number two, it is quantitative easing or tightening, or in short, QE or QT. Now, even though they are different, right, the goal is the same: to control inflation, support growth, and keep employment stable. Okay, so think of it like this. So interest rate is like accelerator, right? When they raise the rates, it's like pressing the brakes. And when they lower the rates, it's like encouraging the economy to speed up. That's why you can see when they lower the rates, the market rally. Now, QE and QT is like fuel tank. When they do quantitative easing, it's like they put more gas into the tank so it can run faster and longer. When it does quantitative tightening, QT, it is pulling out fuel from the tank. So that means do not make the car to be able to run for long. Now, what the Fed additionally said is that at December 1st, right, it will be the end of quantitative tightening. Okay, so you can see he used very technical terms, conclude the reduction of our aggregate security holdings as of December 1. Basically, this means that this is going to be the end of quantitative tightening. So basically, for the past 3 years, right, the Federal Reserve has been slowly restricting the supply of money to the market. And now what they are saying is that instead of draining fuel from the market, they are going to stop draining fuel from the market. Okay, that means they're going to let the money still continue to be in the market. But this is not quantitative easing. They are just going to pause on tightening and draining the fuel. Now, if we look deeper into what he shared, right, what he say is by December 1st, okay, so this yellow word is the main thing. But to summarize, right, in plain terms, right, they are stopping the efforts to shrink the money supply, and they want to keep the amount of money in the system steady. Okay, no out, no in. Okay, so they are not printing new money like what we saw in COVID, guys, but basically it is a shift from just maintaining a liquidity in the market. Now, what does it mean for us as investors, right? It means that there'll be more cash flowing through the system because there's lesser being drained out, right? And more cash means what? Lower stress in the money markets and easier access for people to borrow money. Just imagine now the bank has more money instead of the Federal Reserve draining it out. Okay, this can help to keep borrowing costs more stable and easier for companies and consumers to get loans. So it pairs with lower interest rate as well. Now, the Federal Reserve, right, basically what they're trying to do is they are trying to keep the economy stable rather than aggressively fighting inflation. Because, right, what happened is that there was a little bit of a credit crunch that the Federal Reserve said during their last meeting in September. So they want to avoid this liquidity crisis, because if there's no liquidity in the market, if they tighten too much or they increase interest rate too much, the business cannot borrow money, no one has money to invest in the business, things get expensive. So this is what they are trying to do now. So their logic is to stabilize the market first and gradually fight inflation, because the consensus is that the current inflation increase is due to tariffs, which is just a one-time increase. Okay, so they just want to prevent a credit crunch that could make the economy worse, even if that means accepting higher inflation at the beginning. Now, one important thing that the Federal Reserve has also pointed out is this, and he said it a few times, guys. He said that the risk to inflation are tilted to the upside and risk to employment is to the downside, a challenging situation. No risk-free path as they navigate this tension. Now, some of you might be thinking, hey, Bjorn, what is upside and what is downside? Why the risk got upside and downside one? Okay, now basically, what the Federal Reserve means is this. When they say upside, right, it means that the things could push inflation higher. So upside risk has increased, right? That means they think that, oh, there are risks that could push inflation higher. Simple as that. Downside risk to employment has increased, means that they see more things happening that could weaken the labor market. Okay, for example, higher unemployment or slower job growth. So this alone can influence how they set interest rates. Because if the upside risks dominate, right, they'll be more cautious about cutting rates because they don't want to reignite price pressure. But now, what did we see? We see that inflation actually, this makes sense on why they cut the rates. Because inflation, right, it was expected to be 3.1%, okay? 3.1%. But what is the results on this special inflation report? Even though the government shut down, right, it is at 3%. So it was slightly lower than expected. So to them, right, even though you can see that this is above their target of 2%, but they are fighting with what? They are fighting with unemployment rate, which is increasing, right? You can see it's slowly creeping up from 2024 and including the monthly job creation, right? As of the latest data in September, because October the government was shut down, don't have data, right? You can see that the unemployment rate is a bigger issue than inflation. That was why to them, right, even though they see the risk increasing on both sides, right, they have to, in a way, fight the bigger evil. And right now, the bigger evil is unemployment. And it's not just us seeing this data, if we look ahead of the news, and some of you might already experience this and hear from your friends. So look at this, Amazon plans to cut more than 30,000 corporate jobs starting October 28, just 2 days ago. And what they cite is, in the next near-term future, they plan to have 75% of their company being automated. So you can see there is this push of more people getting unemployed, not just in the United States, in the rest of the world as well. And not just Amazon, right? Look at the recent layoff announcements of these so many companies, and these are like big companies, guys, not just small ones. So you can see, right, unemployment is quite rampant across the industry as a whole, right? And that is why when the Federal Reserve sees this, right, they have to make sure that they want to go and fight the one that is like more rampant. So think of it like now, there is two sides that has a fire. One side, the fire is burning bigger than the other side. But both are dangerous if it burns bigger, right? So the Federal Reserve only have one fire hose. Should they spray to the smaller fire or should they spray to the bigger fire? Do you want to go and tame the bigger fire first and then attack the smaller fire? But at the same time, right, they are trying to hope that the smaller fire don't become bigger as well. Okay, so this is what they are doing. They're actually playing this balancing risk, avoiding a crisis without reigniting inflation. Now, because if they reduce interest rates, people can borrow more money, right? They might push inflation up, but they are like still trying to balance it. right? But inflation is still a bit higher. But if the low liquidity in the market, our liquidity dries up, it could become something worse. So they are taking the view that because inflation is due to tariffs, is a one-time thing, they want to stabilize the market first and ensure employment can increase. So in terms of us investors, this might mean a slightly friendlier environment, right? That means that stocks could perform modestly well because interest rate decrease, no more quantitative tightening. But not a massive rally because we've seen how a lot of companies' valuations has been pushed up, especially those in the AI stocks, right? But on the other hand, right, if inflation stays sticky, or if we see the growth data roll over, right, okay, then that might be a bit tricky. But we will see how the data comes about in the next few months, because there's one more meeting in December, and hopefully, guys, we see the government shutdown ends, and then the data, we'll be able to get to see more official data again. Now, that's the update about the Fed meeting. Now, let's move on to the next exciting part, guys, which is the Mag 7 earnings yesterday as well, specifically Microsoft, Meta, and Google. Now, but before that, if you don't already, guys, I also have a Telegram channel filled with personal market insights, real-time macro trends update like you're seeing here today, and as well as investing knowledge that I've learned over the years, plus the occasional video of me rambling about life. And it's totally free to join, guys. So feel free to pause this video here, scan the QR code, or you can join directly from the link in the description box down below. I would love to have you inside there as well. All right? Okay, now let's go on to the next part, which is what they call the battle of the three titans yesterday. Microsoft, Meta, and Alphabet. You can see these three big giants fighting it out. And what actually happened, guys? You can see this is the summary of what happened after the results came out. Google did amazingly well pre-market, post-market up 6.72%. And what are the two companies being beat down? Meta was being beat down 7% post-market, and Meta also down about 4%. No, but the question is this justified, right? So that is what we want to understand, okay? What is the reason for the increase and what is the reason for the drop? Because if it increased but it is not backed properly by good numbers or data, then this might be short-term, right? And the same thing happens on the other end. If the price drops but it's because of something that is not a big issue, then that might be an opportunity. Okay, guys, now let's look at them one by one. Okay, first, Google, outstanding results. Guys, look at that. Everything beat Very, very nice. And you can see they put the EB estimates by 1.9%. Very, very small. But you can see the beat of every single thing that was magnificent. And something very, very big news that actually happened as well is that this is the first ever 100 billion quarter from Google, guys. 100 billion, guys. This is amazing because just 5 years ago, right, the highest quarterly amount was 50 billion, and now it's 100 billion. So you can see he's very happy. And you can see what are the other stuff, right? If we dig deeper, right, tokens per minute. This is regarding their Gemini AI. Active users 650 million. Revenue is increasing at 34% for the size of Google, guys. This is magnificent. And 155 billion in backlog. What does backlog? Backlog means like customers who have paid for their services but they are waiting to deliver. And 300 million paid subscriptions. Now, looking at that again, this is right from their earnings transcript. So this is the same thing, but you can see the important thing I want you to look at is point number 3. Cloud had another great quarter, accelerating growth. The growth rate increased. AI revenue as key driver. So you can see AI is very, very dominant now. And the cloud backlog grew 46% quarter over quarter. So this is very, very impressive results. You can see how Google Cloud has been growing since they started back in 2020. From making a loss, now you can see it's a beautiful, basically you think it's linear, but it's a curve upwards, including their profitability. The operating income is also increasing nicely. What does this mean? It means more and more people are adopting Google Cloud, which is a good news. Okay, so some deeper insights into Google Cloud. How are they actually accelerating it? New customers faster, okay? And guys, we are signing larger deals. This is one of the things that is very exciting. We have signed more deals over 1 billion through Q3 this year than we did in the previous 2 years combined. In 3 months, they signed more 1 billion deals than in the last 2 years combined. So you can see how powerful this is, it shows a very widespread adoption of Google Cloud as well. And you can see that existing Google Cloud customers, they are using their AI products as well. And this FairPrice group, I don't know whether it's our FairPrice group lah, okay? But you can see that they are using a lot of Google stuff as well as diversifying their revenue. So this is what leads to the accelerating growth. Including search. You know, last time people think like Google search is going to die because of ChatGPT. Even some people say that, oh, the new ChatGPT browser is going to kill Google. But guys, do you know that the ChatGPT browser actually uses Google's Chromium backend? So they are still using Google Chrome, guys. So look at this, AI is driving an expansionary moment for search. So you can see that what they say is growth rate is increasing in Q3. A lot of AI investment in search and AI overview. I think that now if you do a Google search, right, the AI overview is super helpful as well. You know, you don't need to use like a GPT separate tool to use it, but even if you search, they give you a summarize as well. So you can see consistent week-over-week growth in usage and queries doubled and ship over a lot of improvements, okay, driving total incremental query growth. So this is a good sign of, you can see how the business is growing. So, you know, is it justified or not? Their growth and their numbers, I think it's totally justified, right? So that is Google. Now let's look at Microsoft, okay, which dropped. Now Microsoft, what actually happened? You can see that revenue was up 26% to 50 billion, also very amazing. And this is like their backlog, right? Increased 51% to 400 billion. Now the important thing is also their cloud, right? Because it's all about cloud services, about AI now. You can see increased 28%, right? And Azure other cloud services also increased 40%. So it's doing very, very well as well, including their cloud stuff. Personal computing, those are the hardware. That one we don't focus. It's not a big part of the business as well, and it kind of declined as well. But more focus are actually into the AI side. Okay, so we look, actually they beat all their earnings. You can see how their cloud businesses are actually accelerating growth. And this is like their normal, you know, LinkedIn, and so not the biggest priority, but the biggest priority is the intelligent cloud. Now, see how the intelligent cloud, their revenue, 31 billion is going to exceed the productivity side soon enough. And in future, this Azure cloud will be the one dominating, comprising the bigger part of their revenue. So we want to see this growing exceptionally well. Personal computing, small part. You know, you can see how many percent is that? Probably 15-20%. But the cloud, I tell you, eventually it'll be a bigger part of the revenue. So that is the one that we want to see growing. If the growth of that one stops, then it'll be very, very concerning. Now, but why did they drop? Why did they drop? The main reason is this. They took a 3.1 billion hit from OpenAI. So if you don't know, right, Microsoft actually invested a total of 13 billion into OpenAI very early on, not just since 2022 when GPT launched. So they started early. But they had a one-time hit due to their investment in OpenAI. But I want you guys to think about it. Is this a recurring investment that they have to do every single quarter to OpenAI? Think about it, guys. Is it a recurring investment? Because if it's a recurring investment, that means every quarter they have to pay. Okay, then we have to factor in every single quarter. But if it is a one-time thing, will it happen next quarter? Right? Will the numbers look better next quarter? I want you guys to think about it. And you can see that they invested a total of 13 billion and 11.6 has already been funded already. They are key partners, but you can see that they're increasingly become competitors. But remember, they are helping each other as well. And yes, they are competitors, but do we think that it will end up being fighting each other? We are not so sure, so we have to see later on. Okay. And next is this was also something which I think kind of affected it, which is just right before their earnings. There was an outage on Azure. Okay, which probably got some people panicky. Like, hey, what happened to Azure? If you guys remember, Amazon a few weeks ago, they also had an outage. I think last week, not a few weeks ago, just last week, they also had an outage. So I think this is something similar. But this kind of affected, I believe, the quarterly results, right? So this is also another reason why this might have caused it to drop. So again, when we look at Microsoft, they actually beat on their revenues, they beat on their earnings, except that one-time investment into OpenAI, which is it a bad thing? It might not be. Right? So is the drop justified or not? I'll let you guys to think about it. And let me know what you think in the comments down below. Now, we move on to the last one. Meta, okay, which dropped by the most 7%. But let's look at their results. Guys, again, outstanding results. Everything beat. Now, look at this blue line. Okay, sharply missed EPS estimate due to a 16 billion Microsoft for 3 billion. This was 16 billion. Okay, but look at their guide. Everything was beat. They even forecast higher guidance as well. Everything raised to higher guidance. But the stock dropped 7%. How come? Okay, let's go and dig deep. Okay, and I think you're going to find this very, very helpful. So pay attention to this. Now, first, let's look at what they say about CapEx spending. So you can see that first, they also raised CapEx spending from 66 billion to 70 billion. This was also what caused people a bit concerned because they are going to front load a lot of investments. Now, the question on people's mind is that, hey, if I invest now, will I get the returns or not? Will I really get the returns? What is the return on investment? This is an unknown, not even for Meta, for every single AI companies out there. This is what gets people concerned because now they are raising their spending. This is the first point. The second point, if you look at their numbers, guys, if you look at how they've been growing their revenue, how they've been growing their operating income, how they have been growing their free cash flow, it is very consistent. But some people might say, hey, Bjorn, but the free cash flow is dropping every quarter. Is it a concern or not? Now, to me, I don't think it's a concern. Why? Because we have to understand what are they spending on. They are spending on AI infrastructure, right? But they have to spend on it because if they don't spend on it, they risk falling behind. So we must understand the context of why the free cash flow is dipping rather than thinking it is a red flag all along, right? Because you can see if the free cash flow is dropping, but the revenue is also increasing and the income is increasing, right? It shows that it is actually converting in a way, okay? But this is like on the broad overview, but we also want to make sure and see what they say exactly, okay? Now, again, so you can see, this is what actually happened. You can see that their pre-tax income actually was very steady, guys. Increasing very, very nicely. Okay, you can see Q4 increase, but probably there's some seasonality. But what happened is the net income dropped 82% from 1 year ago. From even last quarter, 18 billion suddenly dropped to 2 billion. And I think this scared everyone. Totally everyone was like, oh my God, what actually happened? Right? What analysts expected was 6.72 earnings per share and it got 1.05 earnings per share. Down 83%, and you can see, how the news said it, down 83%. But read it carefully. The most important line is not this line. The most important line is this. That number reflects a one-time non-cash income tax charge of 15.9 billion, which Meta said was required to implement the longer-term savings from President Trump's bill. Okay, without the charge, Meta said it would have been 7.25. Now, guys, this is the key thing. Now, again, I want you to ask yourself, look at what they say here. Is it a recurring charge or is it a one-time charge? Okay, is it a cash expense or is it a non-cash expense? And last but not least, what is this for? Is this for the greater good of the business in the long term? Or is this something that really affected the business materially, that they cannot run the business more in future? Think about that, because when you think about that, then you will start to question yourself, is this justified or not? Right? That is all why we are doing here. We don't want to just see the results, see news, and like, oh my God, this is bad, man. Let's run away from Meta. No, we want to understand deeper the surface, and then we can assess properly whether it's a good thing or it's a bad thing. Okay, and let's look at what they say. Other stuff. Look at the number of people using. Okay, so I'm not going to go through every one, but you just look at all their numbers. Okay, their cash and cash, all kind of stuff. But very important, look at this. The daily active user, 3.5 billion. Average price per ad was increasing. Ads impression was also increasing paired with the revenue as well. Okay, now you look at the numbers. 3.54 billion of people use at least one app, guys. Okay, the daily active users. That means 3.5 billion people at least use Facebook, Instagram, or WhatsApp every single day. Guys, in the world, right, there is 8.2 billion people. This means that 43% of the entire world uses at least a Facebook product. Guys, this is phenomenal, guys. They are so entrenched in the world, no? And then some people might think, oh, Facebook is dead. Facebook, no one uses Facebook. Guys, trust me. Facebook, many are still using. Another reason is businesses are also still using because it has one of the best conversion rate. And they are always innovating Facebook, guys. Don't forget, right? They are including Reels, they are including many, many things to make it such that people will still continue to use the platform. And even so, right, even for Facebook, it's used for the older generation. What about the younger generation? What are they using? If you have kids, ask your kids, hey, boy or girl, what platform are you using now to go and scroll social media? Ask them. right? Are they using TikTok or are they using Instagram? Okay, go and talk to them, because when I was taking the MRT just this morning, there was a secondary school girl in front of me, and she was scrolling her phone on social media, the videos, and I thought it was TikTok. And then I realized it's actually Instagram Reels. Okay, so think about that. Ask the people around, right? And you will realize that Facebook, Meta, is actually entrenched in many people's life. And WhatsApp, every single one of us use WhatsApp lah. Okay, now, I know that to summarize every three, right? Okay, there's also something, a commonality that everyone will ask: CapEx spending. Okay, so you can see, right, this is their forecast. You can see that what is the common consensus for Google and Meta. Microsoft didn't disclose, but you can see Google and Meta forecast that their CapEx will increase. Microsoft never disclosed, but they will probably highly likely also increase one. Why? They have to increase. Guys, now think about it. Now, you pair with what the Federal Reserve is doing. They are reducing interest rates, which means there's more money in the market. I tell you, in this AI's arms race where everyone is running to go and kind of get the investment and the infrastructure up, right? If they don't spend, they risk falling behind, right? They risk losing market share to all these leaders. So it's kind of like better to come out who will become first lah, in a way. But in this case, all will win. But if any one of them falter, right, then this might be dangerous. So that's why they have to spend. It's not that they cannot spend. Like, it's good thing that they spend. Actually, if they don't spend, right, you should be even more concerned. I will be even more concerned. Now, what is my overall thoughts of everything that we see? Okay, what the overall thoughts is that these three are still clearly front runners, right? The demand picture hasn't changed, okay? And it's still stronger than what the supply can handle right now, especially around compute and infrastructure. And this is why all of them are still ramping up CapEx aggressively. So it's not a choice, because if they take their foot off the gas, they risk falling behind. And what they are building is a short-term pain in terms of the spending, but it's for long-term advantage. But if the short-term pain can still, they do this spending, right, but it can still be backed by increasing revenue, increasing earnings, I think that is fair. But if they are the earnings is dropping and their spending is increasing, that is a bigger concern, okay? Now, so slowing down means losing ground, and the only thing, this is what people are concerned, the investments now is squeezing margins in the short term. Key thing is what? Short term. But will this give long-term benefits? We will see, okay? But so far, you can see that they have been innovating and it has been doing quite well. Next, top line growth remains strong, but investors now want to see ROI and margin recovery. Exactly what I said, right? So the key question is, over the next 3 quarters, can they show ROI on these massive investments? Okay, and right now, right, what are we in now? We are in the build now, prove later phase. Now, this might be very familiar to some of you. Back in COVID, right, where you see some non-profitable companies spending a lot of money to build now and prove later. And many of these companies end up couldn't make it, right? But the difference between then and now is what? Then companies are not profitable, which are spending a lot. But now, right, companies like Meta, like Google, like Microsoft, you can see even though they are spending, right, they still have a lot of cash reserve. They are still generating cash within the business as well, okay? So it's not, to me, right, I think that it is important to discern the difference and not think of that is the same thing as in 2020. You want to understand the differences between the companies. Because the key thing, if the company is profitable, yes, even though short term they might face some volatility, but in the long term, if they are very sticky, they have high switching costs and all that, right, these investments might pay off multiple returns down the road as well. Okay, so that is a summary of both the Federal Reserve as well as my overall thoughts on this. The 3 earnings. I hope that this has been very, very helpful to you. If you enjoy, maybe you can just let me know down in the comments what you took away most from this sharing, okay? And last but not least, right, I personally would love to connect with every single one of you, okay? So feel free to connect with me on Facebook. This is where I use more often, guys. So, it's the same thing, right? I support Meta, then I have to use Facebook also. And I think that Facebook is still very amazing, right? I use it on a daily basis. So connect with me. You can scan the QR code or feel free to just pause this video. Alternatively, you can click the link down in the description box below as well. Okay, hope you enjoyed this video, and be sure to like and subscribe, and I'll see you again in the next video.